and good afternoon all. We would like to welcome you to our fourth conference call with Fund Selectors. It is a great honor for the RankiaPro Europe team to organize these conference calls, and we thank our three wonderful speakers for agreeing to participate in today's call. For this call, the topic to be discussed will be portfolio diversification, which we can all agree is really relevant now. We are thrilled to have with us today three investment professionals who have extensive experience in the asset management industry and who will certainly provide for a very insightful conversation. On that note, I would like to welcome Karol, Ciuk, Bruno, Dhoosche, and Andrea Profeti, our three guests for today. Let's get things started by briefly introducing each of our participants. Trust me, their CVs are much longer than this, but I just want to briefly introduce them to you guys. Karol Ciuk is Head of Global Strategies at Pekao TFI, and he's in this position since 2017. As Portfolio Manager, and since 2019, he's also Head of Global Strategies. He has close to 10 years of professional investment experience in various roles and in several finances institutions in Poland. Bruno is Head of Investment Research and Head of Fixed Income Strategies, and is also a Senior Fund Analyst at Allfunds. Prior to joining Allfunds in 2015, Bruno worked for SAI Investments for more than 11 years. He started his career in 2003 as a client portfolio manager in Paris. And Andrea, he's our Senior Investment Fund Advisor at Indosuez Wealth Management. He's a Senior Fund Analyst within the European Fund Selection team at Indosuez. And Andrea is responsible for about 2 billion assets under management, and he has developed quantitative models for manager selection and is involved in the process of creating portfolios for Spanish clients. With this, I would like to welcome all three of you. And now that everyone knows you a bit better, let's get started with a few icebreaker questions in our debate section. First, I would like to ask you guys this question, which goes, do you think having a conversation about portfolio diversification is relevant right now? And why do you think if that is? Andrea or Bruno, feel free to start.
Okay, I can start. Thank you very much.
Sure. Thank you. Thanks a lot for, first of all, having us. Very happy to start opening up the discussion about portfolio diversification. I think portfolio diversification is always relevant, whatever the market, and especially whatever your experience. So this is something that we are continuously debate how to better diversify. Do we want to diversify even more, and how can we improve through diversification? So I was saying that it's always relevant to have a discussion around portfolio diversification, because all of us as professional investors, we always want to find the best diversification benefits, the more upside potential in our portfolio at the cheapest cost. So that's always relevant to have diversification benefits and portfolio diversification discussion. So right now is the right time. Yes, indeed.
Perfect. Guys, anything to add? Karol or Andrea?
Yes, and I would like to add, I agree with Bruno. Portfolio diversification it's always important, but I would say that, in my opinion, it's particularly important now because we are at a point where markets are very close, especially in the equity side, to their maximum. And in this moment is when it's more important, in my opinion, to have a well-diversified portfolio, because when the correction comes, then it's the moment in which it's important to have a very good diversification, because you will see that it's so easy in a way to make money when assets or majority of assets goes up. So everybody is a good trader, and we saw during the first part of the pandemic, especially with their Robinhood traders in the US. But then when markets gets lateral or even are downtrending, it's more difficult to get good returns. And so it's in that time that it's important to have a well-structured portfolio. And in order an investors to have this well-structured portfolio, he has to be prepared ahead of the events. So you cannot wait that the market correct to position yourself. You have to be able to do this correct positioning before. And so, in my opinion, it's really relevant now. And I think investors should monitor properly their portfolio to see if they are well positioned for the next few months.
Perfect. Thank you so much. I will get to our second question, and maybe Karol, you can provide some insight on that. So the Bloomberg Consumer Comfort Index has improved recently, but remains well below the pre-crisis level. So the vaccine might take a couple of months still, and so the observation is that the COVID situation is still dictating the economy's direction for quite some time. And as we know that restaurants, bars, tourism, hospitality sectors are still pretty crushed. And according to data, on average, we are still infected up to 47% from a year ago. The question is that when is it foreseen for the economy to start to recovering? And do you guys have any insights on this? Do you think in the upcoming month we will see a recovery trajectory?
Yeah, so first of all, good afternoon. It's a very good question. I would say that the COVID crisis, it's especially really hard for every economist regarding the market predictions. So what we've seen this year is that it's really hard to forecast what will happen in the particular weeks or days even regarding the pandemic and its impact on the economy. But for sure, I think that the worst is behind us, and the vaccine news is something which can give a bit more boost to consumers and at the end also support the global economy. Of course, right now we know that the vaccine will be distributed. We need some time, I think few months to distribute it among, let's say, the number of people which can give some support to the society and much more limit the restriction. However, the restrictions which are presently in many countries, generally globally. So I think that the early months of New Year would be a bit difficult from this perspective, but the farther we are, the closer to the end of the year, we will see much more the recovery and the uptrend on the global economy. So I think that the next year, the next month is going back to new normality in the global economy. And I think that, of course, there is still a lot of uncertainties regarding the effectiveness and the distribution channel, supply chain, regarding the distribution of the vaccine. But generally speaking, we are going to see the recovery in the economy next year, coming months.
Perfect. We all hope that what you expect is all going to be truth for everyone. So without further ado, thank you all for the introduction piece. And I would like to start our presentation with Andrea's section. And as I mentioned, he's our senior investment fund advisor at Indosuez. And Andrea, you can start your piece of the presentation, or feel free to further introduce yourself to the audience.
Okay, perfect. Thank you very much. Thank you for hosting me in this conference. I'm very happy to share the screen with the other two colleagues. So as you can see on page 5, I would like to start first of all by the definitions of portfolio diversification. So portfolio diversification at the end of the day is the process of investing your money or your client's money in different asset classes and securities with the objective to reduce the overall risk of the portfolio. So in some way, it's giving up some of the upside to protect you in terms of reducing the risk. The objective is really to reduce the part of risk called unsystematic. That means the risk related to specific company or market segment, while the market risk, the broader risk, will still remain on the table. And then we say, how can we reach portfolio diversification? Portfolio diversification, it's reachable investing in more than one type of assets. So investing in bonds, equities, rates, commodities, and so on. Investing in more than one security. And at the end of the day, what is important is that the assets in which you invest have not a significant correlation one to the other. The benefit, as I was saying, is trying to maintain or reduce a bit the similar level of return, but with a lower level of risk that is typically measured by the volatility or by the drawdown. So it's a concept that is quite, I would say, clear and simple in some way, but it's really, really important to have in mind at the time on which we construct a portfolio. On page 6, we define how we can get it, how to get it. And so there is a simple and naive way that is called the naive diversification, where simply you invest in different securities, I would say at random, without any particular study or analysis. And so in this way, you hope that you will lower the risk of the portfolio simply due to the varied nature of selected securities. And in this example is if you want to invest in a portfolio, let's say, of bank stocks, you can choose, instead of investing only just in bank A, you choose 5 or 6 banks, and you hope that in this way you have a lower reduction of the volatility of your portfolio. And then there is the optimal diversification. That means that it's a strategy where the focus is on detecting the assets whose correlation with one another is not perfectly positive. So in this way, you don't do it simply by random, but you use computers so that you run models and algorithms in order to find the ideal correlation between the assets. And so you try to minimize the risk and at the same time maximize the return. So at the end of the day, you run an optimization using data, and so in this way you get obviously a better portfolio than the one you can get with naive diversification. So the idea it's always the same, trying to use in both the diversification, you try to invest in more than one type of assets, not correlated, and so you try to reduce the level of risk and maintain the similar level of return. On page 7, there are some way the limitations of the portfolio diversification. First of all, and I would say, on my opinion, it's the most important is the correlation, because correlation among assets are not constant; they change along the time, and especially they change abruptly when markets conditions worsen. And in this case, diversification is less effective. And we had an example in every crisis, but also in the pandemic crisis of March. We saw that all the major assets, or the majority of the major assets, with just few exceptions, were all trending down. So many portfolio that was supposed to be diversified, they have not enough diversification to protect capital. So this is what I call the extreme conditions. So when there is an extreme negative condition, correlation shifts rapidly and increase. It goes close to 1 for many assets. Typically, all the equities and the riskier part of the bond markets fall together. So just sometimes gold or government bonds of the major markets like US, Germany, or Japan, the dollar are the asset that protect. And so in this way, it's important to take in mind. And so what we have to do in these cases, we can see on we can say that it's first of all review your portfolio on a timely manner to check that the portfolio is working well, and test your portfolio for the most adverse condition, because after some period of positive market, typically investors forget that it may happen at a very negative period, and so the portfolio cannot work properly. So on page 8, we see other two aspects. One is that we have to avoid, on the other side, the over diversification, because if from one side it's not correct to put all your eggs in one basket, on the other side you don't have any benefit in over diversification. That happens when the margin loss of the expected return is greater than the marginal benefit of the reduced risk. This is something that is important, and because otherwise you can incur in excessive trading costs that are not delivering any positive return. And then it's important to remember that correlation change over time, and so you have to adapt the correlation input that you use in your model. Otherwise, the benefit of diversification are completely lost. So if we want to sum up in 3 phrases, first of all, diversification means pick assets that don't move in the same direction at the same time. It's important to have a variation by asset, country, size, industry. And then the third one is to rebalance regularly to keep the portfolio well prepared for the next market. And on page 9, I wanted to simply to see that the importance of portfolio diversification stay in the law in some way, because UCITS rule, for example, for mutual funds has a diversification, the so-called rule 5-10-40, for which its mutual funds manager are obliged to have a minimum of portfolio diversification in order to not increase the concentration risk. And then another typical reference is how the equity fund managers, for example, they typically invest in between 30 and 50 stocks. Some of them can have even more, up to 100, but it's very difficult to see funds that have less than 30 and more than 100 stocks. On the other side, on the bond side, you see that typically the number of issues it's higher. It's very rare to see a portfolio manager with less than 100 issues. So that means that portfolio diversification is important, but that fund managers don't want to exaggerate and to over diversify. So the idea is not to put all your eggs in a basket, and so you have to diversify, and you have to be patient and give up some of your potential reserve in order to reduce the risk. In this way, and I think only in this way, you can be prepared for the most difficult market environments. That it's when the portfolio diversification is really helpful.
Thank you, Andrea, for this really insightful introduction piece, and thank you so much. And I would like to give the word to Karol. If you want to introduce yourself further or just start right in, that's fine too. I would just like to mention for our audience that if any question comes up, regarding any of the presentations, please feel free to leave it in the chat box, and our selectors will get to those questions in the end Q&A section. Karol, it's your time to shine.
Thank you, Liliana. Okay, so I think we can move to the presentation. Andrea gave us very interesting and very good background of the diversification and its benefits. What I would like to show you will be a bit more focused on the recent market moves and trends, and I will focus a bit more on data which are showing how the diversification works and could work in practice. So let's start from the from this year, from the market crash we've experienced in February and March. I think it's really a great example to review how different asset classes work and what kind of benefits we can expect from the portfolio in such a case of black swan on the market, very sharp drawdown, let's say honestly unpredicted pace of crash. And as you can see on the slide, we saw only taking into account the liquid asset classes, the only asset class which were really the benefit of the mess on the market was the safe haven treasury market. This example is focused on the US market. As you can see, some example of ICE, Bank of America, Merrill Lynch indices. US Treasury index was up close to 6% during the drawdown between 19th February and 23rd March. When we go to a bit more riskier asset classes, as you can see, corporates like investment grade, high yield, even AAA US corporates were close to 7% down on this market crash. As we know, the Federal Reserve, due to this significant market crash, reacted implementing several programs to support the liquidity on the corporate market. But even the safest corporates with very low probability of default saw and was under significant pressure, falling with the market. When we move further and look at the whole US investment grade market, we see minus 12.4% down on the closing prices, and triple B's minus 15. So double-digit decrease, double-digit drawdown of investment grade space was something probably investors didn't expect to have on their portfolio. But when we look to more riskier high yields, it's even worse. Of course, as we all know, the high yield space is much more correlated with equities. Of course, the default rates probability during the recession times are the highest among fixed income. So double B's and was minus 19%. The whole US high yield space was more than 20% down, and triple C and lower ratings were close to minus 29%. Of course, equities was the worst, let's say, asset class. Russell 1000, so large and mid-cap US equities, minus 35% and minus 40% from US small cap space. So this slide shows, I think, quite precisely there is no free lunch on the market, and the higher risk we take, the higher potential loss during the bear market or the market crash like this in 2020. But the only one which worked well was the treasury. That's why I think that talking about diversification, especially focusing on, let's say, simple rules, I would like to focus on the hypothetical balanced portfolio of US treasuries and US stocks. So I will include corporate because, as you can see, the diversification benefits are of course possible, especially due to lower drawdown than equities, but you can't say that this asset class will behave differently during the market shock. So what Andrea presented, the correlation during the bear market, the crash, is on average rising among asset classes, but it's not the same case within treasuries. So on slide 12, you can see the return contribution of US balanced portfolio since 1988. And as you can see from this slide, the blue bar is showing the contribution of 7 to 10 year US Treasury Index, 40%, and the orange is showing 60% Russell, and you can see also the total return of the balanced portfolio. So this hypothetical portfolio in 1990s was showing quite a nice return on average, many years with double-digit returns, but as you can see also positive returns, quite significant positive returns from the treasury side. What worked quite well was that the composition of the portfolio in the late 1990s, when we saw the dot-com bubble burst, and we saw that the drawdown from equities was equalized partially by the treasury side. So using the treasuries as a portfolio diversifier was a good enhancement and drawdown protector for the total portfolio. Then the same situation occurred during the financial crisis in 2008, when we've experienced significant drawdown of equities and quite good return from the treasury side. And moving further, we see also this year, which let's say is a bit crazy one from the perspective of the shock we've experienced. So the global economy in recession, and we see right now equities are in the US on all-time highs. Of course, it's due to very coordinated action from central banks and fiscal policy, but we see that treasury side, especially during the March drawdown, which I showed at the previous slide, was really good downside protector, partially of course downside protector of the portfolio. So moving to the next slide, I would like to focus a bit more on correlation. So as you can see, in 1990, so this is 5-year rolling correlation of monthly stock and bond returns. We are using the same index, so Russell 1000, and US Treasury is 5 to 7 years. So since 1985, this correlation was positive. Of course, it was lower than 1, so we still had significant positive diversification benefits from using 2 different asset classes. But since 2000, in this century, we see that this correlation is even negative. So this correlation benefit, this diversification benefits are even higher. So what's the reason? Of course, the reason is that in 2000 we saw the dot-com bubble burst, and also the treasury side worked quite well as a portfolio diversifier. In 2008, a very similar situation. And what is really important also from this perspective, that in 1990s the yields on the treasuries was much higher. So when we are moving to the next slide, slide 14, as you can see on the slide, the yield of ICE Bank of America 7 to 10 year, so YTM of this index was more than 6% in 1990s, even more than 7 in some times. And the treasury part was really not only the diversifier of the portfolio, but gave us a significant, was able to give us a significant pickup of yield of the portfolio. When you see it, the red line is showing the earnings yield of the Russell 1000. And in 1990s, the yield, so YTM of fixed income market, safe haven treasuries, was even higher than the yield from the stocks. The situation changed in 2000, a bit closer to the financial crisis, mainly when Fed implemented the quantitative easing, and you see the significant and very significant downtrend of the yields. So right now, yields of this index are close to 70 basis points, which is really small. Much higher yield are giving us equities, but the fixed income is still a good diversifier of the portfolio because of the fact that it's working very well on the stress market environment. So what I would like to say here is that the valuation of fixed income are high, and many investors can think about it as, let's say, a dangerous part for the portfolio, but from the perspective of really significant support of the central bank, the diversification benefits of the treasuries in the portfolio are still significant, and we should use it as a part of our multi-asset portfolio, in which we would like to protect part of our drawdown. So moving to the next slide, I would like also to focus on this part of the yield. As you can see, the blue line is showing 5-year rolling return, the contributor to the balanced portfolio from the treasury side, so the 40% of the treasury side, and the orange line, 60% of the equity Russell 1000. The gray one is the total portfolio. So as you can see, the dot lines are the linear trends, and both fixed income and equities trends regarding the 5-year rolling returns are decreasing. So what we can expect in the future is, for sure, maybe not for sure because we don't know for sure the future, but with high probability this downtrend will be visible, and these returns in the future will be lower, especially due to the fact that we have very low yields on the treasury side and quite high valuations in the equity part of the market. But at the same time, treasuries are still offering quite good diversifying opportunity to our portfolios. Even in this low yield environment, we should remember that diversification is the best way to enhance our risk adjusted return. We can be very good stock or bond picker. However, diversification from this perspective is the best, and what we saw on the market during the March crash is convincing us that the treasury part mixed with the equity side of the portfolio can limit the drawdown of our portfolio and our strategy.
Thank you, Karol. It was very, very interesting. And I would like to give the word to Bruno. As in the beginning, I mentioned he is head of investment research and head of fixed income strategies at Allfunds, and he is going to proceed with this part of the presentation. Bruno, as I mentioned, please feel free to further introduce yourself, or we can just get started with your presentation.
Thank you, Liliana, and thank you, Karol, and thank you, Andrea, for your very insightful presentations. I will try to add as much as possible to what you already explained to the audience. So if we move on to the slide 18, I will take over once again, just like Andrea, what are the basics of portfolio diversification, but hopefully bear with me this slide. So Andrea already mentioned all of that, and Karol as well to such extent, but the following slides, I will try to go over some practical aspects and as well some interesting thoughts. As professional, we need to ask ourselves and not only blindly follow the traditional financial literature. So if we start with the basics, so we all know that investors should own diversified portfolios. Okay, we've heard that 1,000 times. All of us. But why? When we think about it, why do we really need a diversified portfolio? So the traditional textbook answer is Andrea and Karol. This is something that sticks to our minds because it's so painful. It's very painful, and you attached a lot of emotions to that. So we want to minimize that. And so how do we go about it? So the main metric, to assess the patient benefits is the correlation. So correlation has been mentioned a couple of times, so I will not dwell on this notion. But the main tools, how do we use the correlation is through the efficient frontier. The efficient frontier is basically a specific level of return. So that's really what you can call the efficient frontier. And here you can see an example of an efficient frontier. This is taking from US equities and US treasuries from 1990 to a time period very close to what Karol has been able to show you on his own slides. And you can see that if you diversified 80% treasuries, 20% equities, well, it seems that you have the efficient portfolio here. And eventually that enables you to have some risk reduction versus 100% fixed income and a lot of risk reduction versus 100% equities, but as well some return enhancements. And that's due to the imperfect nature of the correlation between fixed income and equities. So those are the basics, and I think all of us, we're very comfortable with that. So thanks a lot for hanging on with me. If we move on to the next slide, here I would like to dive a little bit into, so slide 19, if I would like to dive a little bit into the practical aspect of the portfolio diversification. Thank you. So the concept of efficient frontier, this is all well, this has been very well documented, but in real life it's quite difficult, and we all struggle with that because we can all construct very nice Excel files, we can all tap into a lot of databases and extract a lot of data and a lot of information, but actually when we put paper portfolio into action, most of the time we're disappointed, and the reasons for that are not that trivial, but some of them can be explained relatively easily. And I will start with the most simplified assumption that is used throughout mainly the literature, I have to say, is the fact that we believe that returns follow a normal distribution. So one of the problem is the normal distribution of returns. We all know that distribution of returns are not normal. So tails are fat and black swan events happen, and over the last 20 years, they happen much more than what the market, what is supposed to happen. So another problem, and here I'm very happy that in Andrea's presentation, that was one of his bullet points, but this is way too many times overlooked by practitioners, is the need for rebalancing. And the need for rebalancing is critical because without rebalancing, you're not able to reap out all the benefits that you can get through the long run, through a long time investment. So this is critical for me as well. Another aspect of why the efficient frontier is actually quite difficult is that we are tapping databases and we're looking for historical returns, historical volatility, historical correlation, volatility and future correlation. So this is something to bear in mind. And this is something that is one of the shortfall of the traditional tools that we have at our disposal. That, as I think Andrea mentioned, diversification benefits moves around according to the market environment. So sometimes it's highly effective, sometimes it's highly not effective because markets are moving into the same direction. So short-term investors, be careful. Diversification effectiveness will vary over time, and you can be trapped in an environment that is not conducive remain solvent thanks to John Keynes, right? So this is a very practical aspect in a sense that you can be right in the long run, but you won't be able to be solvent long enough to make your point. So all of that means that in real life, this concept of portfolio diversification is not that simple. Asset classes that are directing into different ways, and that will enable you to have effective diversification benefits, even if the correlations are moving around, as Karol mentioned in his very nice charts. If we're moving to slide 20, actually, I will take over the different examples that Andrea put together. Is that you can diversify through many different things. You can diversify through asset classes, so fixed income, equities, as well as real estate, or alternative investments. One very effective way as well to diversify is through different regions and through different countries where historically the different market environment impacted by different political environments or pure economical cycles. So that's very effective. And you can diversify effectively through different securities as well. Plus, you can add a lot of things. But basically, traditional finance will try to encourage you to diversify up as soon as you're comfortable with this risk tolerance. You don't need to diversify away even further, as Andrea, that markets can go haywire. And over the last couple of years, they went haywire more often than we hoped for. And when market diversification go haywire, if your portfolio was not well diversified at the beginning of it, actually your portfolio diversification has been of limited use, and your risk systems are completely useless. So what you're left with experience. Experience is key. Experience of the portfolio manager, experience of your view of the market, experience of how do you want to play that. This is critical. And another thought that I will be very happy to share with you is when you are unsure, you can diversify your portfolio. But actually, when you're convinced of the direction of the market, everything should tell you that you should have a concentrated portfolio into where you're comfortable with. So after a major drawdown, if you're really comfortable with equities, well, you go with equities and you double down and you will reap most of the reward. But this, I hope it was not too
Bruno, I think we're hearing you a little bit off.
redundant with the slides of Andrea and Karol. And I would like to apologize for my connection, which seems to be quite bad today. But
Yeah.
this is the only points that I wanted to share with you today.
Thank you so much. And sorry to everyone if you also heard Bruno a little bit badly, but sometimes this is the big difficulty with conference calls, that the connection and the technology is not always on our side. But regardless, thank you, Bruno, for the insights. And I hope everyone could follow the presentation through the slide. So without that, I would like to pass to some of the questions. And Karol or Andrea, please feel free to jump in and also answer these questions. So the first question we would like to ask you is, what is an appropriate reaction as a fund selector when markets go down, and even with diversification, the overall portfolio is down? And if you could just give us some insights what are the steps that needs to be taken in this example? And even with our best used tools, as we could see from Karol's slide, even our AAA portfolios are down. So Andrea or Karol, please feel free to answer.
So I think that the best way to prepare for such event is to prepare before. So as mentioned, the diversification has its own limitations, especially when we see the tail risk events, like swans, like pandemic crash on the market. Then for sure the reaction of the market is really fast. What this experience learned us is for sure that it's really hard to be faster than the market when the moves are so sharp. So the optimal way would be to prepare before, so to have already good diversified portfolio. Of course, sometimes it's difficult. It's sometimes your, let's say, risk attitude is too so you are too risky in your portfolio in late cycle. So I think what we could think over while diversifying our portfolio would be to fit it into the market cycle, and maybe diversify more even when we are later in the cycle. Of course, it's really hard to predict some events in the market. That's why diversification is so important, can increase our risk-adjusted return. But as mentioned, so depending on the asset class, you can expect different kind of drawdowns and returns. So you should be aware of and stress test your portfolio to check what kind of return you can expect depending on the market environment. So I think that the simple answer is just to try to assess it before, to be prepared and not surprised by the market.
Andrea, do you have anything to add on this question? I think you're on mute, Andrea. Unmute yourself first.
Can you hear me now?
Yes, perfectly.
Okay.
Thank you.
Okay, so for me, the point, as we were talking previously, is to be prepared ahead of the event. And as Karol was showing in his presentation regarding a balanced portfolio, for example, for me, it's key to have always a portion of the portfolio, maybe sometimes in government bonds, because at the end of the day, among the liquid assets, usage assets, they are the one that can protect you when there is a strong market correction. And I remember that at the end of last year, the beginning of this year, it was very difficult for me when I was talking with our bankers and clients to let them accept any portion of their investment through government bond funds, because they were saying interest rate are negative, so they doesn't have any benefit in the portfolio, but because people was forgetting the period of crisis. And so it's a solid portfolio, in my opinion, has to be prepared, has to be constructed in order to deliver a good risk-adjusted return also in very negative scenarios. And that's important, as I was saying at the beginning, in a period like this one now, because we can be at the end of a stronger bull market, and so we have to prepare ahead of a correction. So I would say for me, the basic is, as Karol showed, that you have some portion of the investment also in government bonds, because we have seen that the AAA or AA are not able to protect when there is a strong risk aversion in the market.
Yes, and this is, I think, really, really insightful. The dynamics of this recession are really different from recessions of the past. Of course, this is a healthcare-related crisis. And with the unprecedented levels of central bank action and keeping the rates extremely low, what do investors particularly need to take note of? And this time around, how would you say the diversification could be even different than it would have been in 2008 or something like that? Do you have anything to add on that?
So, adding to this question, the anatomy of this crisis is much different. I agree. We have a very strong support from central banks, very coordinated action, coordinated with fiscal policies. That's why this market crash was really short-lived, however, very painful, but really short-lived. And the market recovery was extremely fast comparing the historical pattern. So what we should be aware of is mainly to understand that market moves currently on this new regime, when central banks are on the market, when we see the government, central banks put on the market, we need to identify this trend, and sometimes we need to adjust and also take opportunity of it. So don't fight with the global liquidity, don't fight with central banks, but it doesn't mean that diversification diversification benefits are not present on the market. Yes, so I think that it's still valid to diversify the portfolio, especially when you see the significant rally of all asset classes, mainly all asset classes, all the risky asset classes, and when you are not feel very confident about the market situation, the diversification gives you some kind of comfort that in any case of pessimism returning to the market, you will still be partly protected, and you will still have the opportunity to take part in this sharp recovery. So I think looking for a balance, optimizing the portfolio, and also trying to determine the market trends. Central banks cause very interesting situation because we can take opportunity of treasuries which are supported by the central banks buying programs in the US, for example, in Europe. And right now, even investment grade corporate, which is supported or may be supported by the Fed in case of market stress. So it will probably dampen the volatility of the IG, the safest IG space in the future. So maybe we should expect that the drawdown in the next crisis, in the next similar crisis of IG space will be lower due to the fact that we have the backstop from the Fed. So we need also to recognize the market pattern, the actions from the central bank, adapt to it, but also take opportunity of these actions.
Thank you, Karol. Andrea, if you have anything to add, you can, or I can ask another question to you maybe.
Super fair. Well, I would say yes, definitely the crisis is different from the previous one. The first time it's coming for health reasons. So in some way it's a crisis due to the lockdown imposed by governments in many countries. And maybe is the first crisis with the so rapid recovery in terms of financial market. Maybe we have a point where this connection between High Street or Main Street and Wall Street is very, very significant. And that's, in my opinion, something that investors should be worried. But I don't know here how to give and help in terms of investments, because I mean, we have seen that all markets, almost all markets have rallied, and it is very difficult now to say what can happen later on. For sure, a similarity with the previous crisis is the huge and massive monetary supportive policies, and central banks have injecting a lot of money, and I think that's here for stay. and that's, in my opinion, the highest support for the market. But in terms of diversification, I would say nothing has changed. Still important as it was in 2020, 28, 29. It's still important now.
Perfect. Thank you so much. We have two more small questions, so I will try to get back to those quickly. So we have a small question regarding rebalancing. Both you and Bruno mentioned how important it is and how sometimes it's an overlooked requirement. Can either one of you can elaborate more on how at your firm is the rebalancing applied in real life, and what can investors look out for when a couple of managers are overlooking rebalancing when it comes to diversification and especially taking into consideration the long run of the project?
Okay. Well, typically for our investments we have a monthly committee. So in normal market condition, what we do once a month, we reset our market views and we rebalance portfolio accordingly. So we overweight the market segment sectors where we are more positive, and we underweight the one where we are negative. And that's for the portfolio that we manage and for the portfolio advised by our bankers for our client. The idea is that during this rebalancing process, we take into consideration if there are switches in the correlation dynamics, and if we see significant switches, so increased correlation between two assets or decreased correlation between other assets, so we adjust the portfolio accordingly in order to try to have a more stable outcome. So I would say that we do on a monthly basis. Then obviously there can be exception for important exceptional event. So in that case, we intervene, let's say, on time when we see that there is a need to change our views and our positions. Normally, the changes on a monthly basis are small. We are not used to change a lot our portfolio because we tackle long-term objective. So we simply want to adjust our portfolio and to maintain it aligned with the long-term objective that the clients give us and that we share with him or her.
Thank you so much. We would have something for you, Karol, regarding the stress testing tools, but unfortunately, I think we ran out of time. So maybe we can get back to those questions in a future conference call. And without further ado, thank you so much for all three of you for the preparations of this conference call and for the really insightful materials. And thank you for attendees for attending our fourth conference call with RankiaPro. And thank you so much. And we will see you in 2021 with more upcoming conference calls regarding investments and portfolio concepts. So thank you so much, everyone. Have a happy holidays and end of the year, and stay safe. Goodbye.